$2.5 billion are currently locked inside Falcon Finance, and this past January, they deployed a brand new $50 million ecosystem fund to expand their global reach even further. Yet the protocol's native token tells a completely different story. After hitting a peak of 77 cents, it crashed. Today, it trades for just 8 cents. This massive gap forces a clear question. Either this is the most deeply undervalued decentralized finance infrastructure of the year, or it serves as a stark warning about how token unlocks can crush price action. In the current crypto market, a highly adopted and lucrative protocol does not automatically translate to a lucrative token. We have to look at how the machinery actually operates. Falcon Finance operates on the Ethereum network as a multi-asset stablecoin engine. This universal collateralization infrastructure lets you deposit liquid assets to mint USDf, a synthetic dollar over-collateralized by its reserves. What's interesting is the collateral. Alongside Bitcoin and Ethereum, you can deposit traditional assets like tokenized equities, gold, and sovereign treasury bonds. Tying this operation together is the FF token, the native asset used for governance decisions and overall utility within the ecosystem. By treating sovereign bonds with the same exact infrastructure as altcoins, Falcon creates a permanent bridge. It routes traditional finance assets directly into decentralized liquidity pools. Normally, if you need stable cash, you have to sell your assets, which often triggers taxable events. Falcon lets you maintain your long-term crypto or traditional holdings while drawing liquid dollars against them. Users can then take that minted USDF and stake it into the protocol to receive SUSDF, a yield-bearing version of the token. This flow diagram illustrates how that yield is actually generated. The returns feeding into SUSDF come from a mix of funding rate arbitrage, liquidity provision on decentralized exchanges, and institutional-grade trading strategies. Falcon is not alone in the synthetic dollar space. Its fiercest and most direct competitor right now is Ethena. Where Ethena currently focuses heavily on crypto-native collateral, Falcon differentiates itself by accepting a far wider range of inputs, specifically integrating tokenized real-world assets. This broad collateral base gives Falcon a tangible technical advantage, allowing it to capture value from markets that its competitors cannot currently touch. The institutional market sees that advantage. The protocol holds $2.5 billion in total value locked and secured a premium listing on Binance. But if you look at the retail community, sentiment is incredibly muted, and the community outlook leans heavily bearish. This pie chart of the 10 billion token supply reveals the pessimism. Only 23% circulates. A massive 76% remains locked. As that 3/4 scheduled supply enters the market, it creates persistent dilution risk for current token holders. Right now, there is simply no confirmed mechanism to burn tokens and offset this upcoming wave of inflation. The token's architecture is misaligned with the protocol's utility, engineered to dilute early adopters rather than reward them. The market response to this supply schedule has been severe. In September 2025, FF reached an all-time high of 77 cents. This line chart tracks the resulting 89% downward trend. By October, it hit an all-time low of just over 6 cents before stabilizing near its current price of 8 cents. As marked on the chart, the next major resistance ceiling is 15 cents. Pushing past that ceiling toward a 30-cent recovery target is possible, but it will require a highly favorable macro environment to absorb the constant sell pressure from the unlocks. For traders comfortable with that risk profile, the token is highly accessible. It trades on Binance, MEXC, BitGet, Kraken, Gate.io, and Ethereum-based decentralized exchanges. The price of FF today is almost entirely a product of its scheduled unlocks. It is behaving completely independently from the billions of dollars successfully flowing through its smart contracts. Looking at the entire picture, the positives are substantial. Falcon has proven institutional usage, genuine innovation in real-world assets, top-tier exchange liquidity, and $50 million in dry powder for ecosystem growth. But the negatives weigh heavily. They face intense competition from Ethena, an 89% bleed in token value, and that looming cliff of 76% locked supply. Falcon Finance is an operationally successful protocol trapped inside a heavily flawed token suit. Going forward, the single most important metric to watch is whether the rate of their total value locked can grow fast enough to outpace the token unlock schedule. If you found this breakdown useful, drop a like and subscribe. We cover decentralized finance and high-potential projects every week. Please remember, nothing in this video is financial advice. Crypto is highly volatile, so always do your own research and only risk capital you can afford to lose. In the infrastructure space, even the most brilliant technological solutions require sound economics. If the underlying tokenomics actively work against the everyday holder, the advanced technology alone simply cannot make it a good investment.